From late 2025 onward, lawmakers and regulators made it increasingly clear that the Clarity Act was approaching its final legislative phase. While exact passage dates remained dependent on congressional scheduling, banks and regulators did not wait for the final signature. Supervisory agencies began preparing enforcement frameworks, compliance timelines were locked in, and major financial institutions positioned themselves as if the rules were already inevitable. Markets rarely wait for laws to pass. They move when direction becomes undeniable. This is why the period leading into January 2026 is better understood as a transition from discretion to obligation. Once enforcement begins, regulatory flexibility disappears. Capital penalties apply automatically, reporting requirements become non-negotiable, and non-compliant exposure becomes economically irrational. The system does not change overnight, but from that point forward, there is no path backward. Within this framework, it is important to clearly distinguish between different digital assets and their roles. XRP functions as a bridge asset designed to move value efficiently between systems. It is not a stablecoin, does not represent a claim on reserves, and therefore does not receive preferential capital treatment under Basel rules. Banks may use XRP operationally for settlement, but holding it on balance sheets does not provide regulatory advantages. RLUSD, by contrast, is architected specifically to meet the criteria regulators outlined for compliant stablecoins. It is designed to be fully backed one-to-one by high-quality liquid assets, structured for transparency, auditability, and legal clarity. Unlike many existing stablecoins that evolved before regulation, RLUSD is being built inside the regulatory framework, not adapted after the fact. This positioning is critical under the Basel III Endgame. For banking partners such as ABSA, operating across South Africa and the broader African continent, this shift represents a strategic advantage rather than a threat. Compliant blockchain rails allow banks to reduce cross-border settlement friction, improve liquidity efficiency, and operate within global regulatory alignment without incurring punitive capital costs. In regions where correspondent banking is fragmented and expensive, compliant digital settlement offers tangible, measurable benefits. Africa stands to benefit disproportionately from this transition, not because of speculation, but because inefficiencies are highest where infrastructure is weakest. Faster settlement, improved transparency, and reduced dependency on legacy intermediaries directly address long-standing structural challenges. This is not theoretical innovation, it is operational modernization. A great deal of online discussion links these regulatory changes to expectations of bond payouts and historical asset settlements. It is essential to separate mechanism from outcome. What the framework confirms is that any legitimate large-scale financial settlement must pass through regulated banking channels using compliant infrastructure. What it does not confirm are specific payout timelines, amounts, or guarantees. Regulation defines the rails, not the promises made about what travels on them. If bond-related settlements occur, they will move through banks that meet capital, compliance, and audit standards. They will not move through private wallets, informal platforms, or opaque intermediaries. This is not speculation, it is how modern financial law functions. When people say the new systems replace the old systems, this does not mean fiat currencies disappear or banks shut down. Replacement happens through gradual migration. Legacy messaging systems lose relevance, settlement layers become tokenized, liquidity moves in real time, and compliance becomes native rather than external. Old systems fade because they are inefficient, not because they are switched off. January 1st, 2026 is therefore not a launch event. It is an enforcement threshold. From that date forward, non-compliance stops being theoretical and starts becoming costly. The shift is administrative, not dramatic, but its impact is structural and long-lasting. For more than a decade, crypto developed outside the banking system. That phase is ending. From 2026 onward, crypto is no longer an experimental parallel economy. It is either regulated, transparent, and capital efficient, or it is excluded from institutional relevance. Infrastructure matters more than tokens, and compliance becomes the defining competitive advantage. This is not the end of crypto. It is the beginning of crypto that banks are allowed to use. We inform, you choose. In this library, we do not give false hope or sensational news. The information shared is based on documented reality and observable regulatory developments.